food, water, energy, security, barterability, wealth preservation, community, and shelter. Aside from all of those mantra pieces, this is what I'm in because of where we are in the trend cycle and the fact that I've studied currencies and currency life cycles since 1987. Who do you know that has done that? And when you see these repeatable patterns, I can't guarantee what's going to happen tomorrow, but I don't know. You tell me. If something's happened the same way every time and we're doing the same thing, do you really think it's going to be different this time? Because I don't. So if you position properly, just based on those historic patterns, then you are more than likely to be in the right place at the right time with the right asset. And what you're in is the most liquid assets on the planet because they run absolutely no counterparty risk and they're used in every single sector. I mean, it is really that simple. That's why you see global central banks. Not only are they buying more gold than they ever have in history, but they're repatriating their gold and bringing it home. Because what do they know? If you don't hold it, you don't own it. The importance of the unrealized losses, those losses that we're talking about. And of course, the banks don't want to talk about them. Why would they? They don't want you to know the truth. They don't want you to know that the most likely outcome in the future is for your wealth to get bailed in, either through hyperinflation or outright theft. Take your pick. If you don't hold it, you don't own it. Because having the right gold and the right silver for your objectives is absolutely crucial. And the more time that goes on, I mean, I can tell you I have stuff that I can't access anymore. Then again, I've been accumulating since 2002. When the banks imploded in March and April of last year, the regional banks, they covered it up really quickly and that they haven't finished, that issue is not over yet. So what's happening is, I don't care what size bank you are, including the central banks, right? Again, it goes back to this. With the interest rate spike, then the value of the bonds that they're holding, the market value has gone down substantially. So what they've done is they've made the changes so that the banks don't have to declare these losses. They can say, well, we're going to hold them to maturity and therefore there's no loss. I mean, there actually is a huge loss, but at least on a nominal basis, they don't have to show that loss. So what's really most likely happening behind the scenes are rule changes to make things appear like they're okay and solvent. I mean, look at Jamie Dimon, look at Chase Bank, right? Had a phenomenal year. Of course, was it so phenomenal that it makes up for all of these massive losses? No, not really. The other thing that I want you to keep in mind, because I just pulled this not that long ago, but the most current diff balance, so that's the balance that the FDIC has to bail out depositors, is lower than it was when they couldn't do it last March and April. So all of those banks that were supposed to, this is not going to cost you any money. The banks are going to reinvigorate and make deposits into that fund. Well, they haven't yet, right? It's at a lower level. So anything that you're holding in the banking system is subject to a run. They don't want you to know that. So they're going to do their best to keep things as hidden as possible. What is going to happen when the government debt market implodes is there will be a spike in interest rates, right? We saw that in 2019 when the money market funds were imploding at that point, the reverse repo market and the repo markets, so we know what's going to happen. You're going to get a huge spike in interest rates.
Lynette Zang, with her extensive background in studying currency life cycles, has been sharing invaluable insights on the shifting dynamics in the financial world. We left off discussing the precarious state of the banking system and the importance of holding physical assets. Let's delve further into this by addressing the concept of wealth preservation and the role of gold and silver. Think of gold and silver as financial lifeboats. In an ocean of fluctuating markets and economic storms, these metals provide stability. When the banks and financial institutions are struggling to stay afloat due to hidden losses and unrealized risks, gold and silver remain buoyant. They don't lose value because someone decides to change the rules or because a financial crisis erupts. They hold steady because their value is intrinsic. Lynette emphasized that if you don't hold it, you don't own it. This is a critical mantra to internalize especially in times when financial systems can become unreliable. The recent changes in banking regulations allow banks to hide their losses, creating a facade of stability. But we must look beyond the surface. The reality is that our financial system is more fragile than it appears, and the safeguards we once relied upon are not as robust as they used to be. Let's talk about interest rates and their impact. When interest rates spike, the market value of bonds decreases. This inverse relationship means that many financial instruments lose value and banks face significant losses. The changes implemented since 2008, such as the introduction of gates and fees in money market funds, are designed to limit your ability to withdraw funds. Essentially, these mechanisms are in place to prevent a run on the banks, but they also restrict your access to your own money during critical times. The Treasury market is another area of concern. Liquidity issues have been surfacing since 2015, and these problems are not going away. In fact, they are becoming more pronounced. The lack of liquidity in the global Treasury market is a warning sign. It suggests that even supposedly safe investments are not immune to market fluctuations and systemic risks. So, what can you do? Diversifying your assets to include gold and silver is a prudent step. These metals are not only tangible, but also universally recognized as stores of value. They provide a hedge against inflation, currency devaluation, and economic uncertainty. By holding gold and silver, you can protect your wealth from the whims of the financial markets and the decisions of central banks. Lynette also pointed out the increasing trend of central banks repatriating their gold. This move is significant because it highlights a growing distrust in the global financial system and a recognition of the importance of holding physical assets. Central banks are preparing for potential economic turbulence by securing gold, and this is a strategy that individual investors can adopt as well. Moreover, the geopolitical landscape is shifting. Nations are increasingly moving away from the US dollar and towards alternative currencies and gold. This trend is not just about economic policy, but also about strategic positioning in a world where financial power is becoming more decentralized. As we navigate these changes, it's crucial to stay informed and proactive. Investing in gold and silver is not just about protecting your wealth. It's about ensuring financial resilience in an unpredictable world. By understanding the historical patterns and current trends, you can make informed decisions that will help you weather any economic storm. Remember, the goal is not just to survive, but to thrive. By aligning your investment strategy with proven principles and staying vigilant about market dynamics, you can safeguard your financial future.
Now, will you be able to get your money out without a loss? The answer is no. And remember, they've done a lot since 2008 when the prime money market froze. They've done a lot of work to modify those contracts in those money markets and put up what they call gates, which is really, frankly, your inability to access them, as well as large enough fees. And as they were putting all of these new terms together, what their question is how big does this have to be to have people choose not to withdraw their money? So the first part would be the fees. No, you're gonna get a loss, because when interest rates spike, the market value of the bonds go down. Now, if this is a shorter term, if this is when a bond is issued and there are shorter term bonds inside of that money market fund, inside of that, right? It's not going to move as much as, say, the 30-year bond, the longer bond. You can see that, right? But the other part of it is the fees that they're going to charge you and the gates, your ability to actually remove the funds. So I wouldn't have any more in there than you feel like you absolutely need to have in there, even in the Treasury market, especially with what's happening in the Treasury, in the global Treasury market, with the lack of liquidity at, frankly, well, maybe not quite all maturities yet, but there is a breakdown that has been occurring since 2015. So this isn't something we're waiting for. This is something that keeps rearing its ugly head.
Lynette Zang has been guiding us through the intricacies of currency cycles, banking vulnerabilities, and the strategic importance of tangible assets. Now, let's explore these themes further and address the broader implications for your financial security. As we've discussed, the fundamental principle of if you don't hold it, you don't own it is more relevant than ever. This principle underscores the importance of physical ownership in an era where digital and fiat assets can be manipulated or restricted. Let's delve into why tangible assets like gold and silver are indispensable in preserving wealth. First, let's consider the broader economic environment. We live in a time of unprecedented monetary policy experimentation. Central banks worldwide have been engaging in quantitative easing, negative interest rates, and other unconventional measures to stimulate their economies. While these policies may provide short-term relief, they also create long-term risks, including inflation and currency devaluation. Gold and silver offer a hedge against these risks. Unlike fiat currencies, which can be printed at will, precious metals have intrinsic value. They are finite resources that have been recognized as stores of value for thousands of years. This historical continuity provides a level of security that fiat currencies simply cannot match. Lynette mentioned the importance of understanding currency life cycles. Historically, no fiat currency has maintained its value indefinitely. They all eventually face devaluation or collapse. By studying these patterns, we can see that the current global economic system is showing signs of strain. Central banks repatriating gold and increasing their reserves is a clear signal that they are preparing for potential disruptions. Another critical factor is the role of interest rates. When central banks manipulate interest rates to stimulate the economy, they inadvertently create asset bubbles. These bubbles can lead to financial crises when they burst. Holding gold and silver can protect your wealth from these cycles of boom and bust. As interest rates rise to counteract inflation, the value of bonds and other interest-sensitive assets declines. However, gold and silver often increase in value during these times, providing a counterbalance to the losses in other parts of your portfolio. Let's talk about the practical steps you can take. First, assess your current holdings. How much of your wealth is tied up in fiat currencies or digital assets? How much is in tangible, physical assets? Diversifying your portfolio to include a significant portion of gold and silver can provide a buffer against economic shocks. Consider the liquidity of these assets. Gold and silver are highly liquid, meaning you can convert them into cash relatively easily when needed. This liquidity is crucial during financial crises, when access to cash can become restricted. Moreover, gold and silver are universally recognized. No matter where you are in the world, these metals hold value. This global recognition adds another layer of security, especially in times of geopolitical instability. Another point Lynette emphasized is the ongoing trend of central banks repatriating their gold. This move is not just about securing physical assets. It's also about reducing reliance on the global financial system, which can be subject to sanctions and other geopolitical risks. By holding gold domestically, central banks are ensuring that their reserves are protected from international political pressures. For individual investors, the lesson is clear. Follow the lead of central banks. Secure your wealth in tangible assets that are not subject to the same risks as fiat currencies. In an increasingly volatile world, having a portion of your portfolio in gold and silver can provide peace of mind and financial stability. Lastly, consider the potential future scenarios. If we face a period of hyperinflation or significant currency devaluation, the value of gold and silver is likely to increase dramatically. These metals have historically been safe havens during times of economic turmoil. By investing in them now, you are positioning yourself to not just survive, but thrive in uncertain times. In conclusion, Lynette Zang's insights highlight the importance of understanding historical patterns and current trends in the financial markets. By diversifying your portfolio to include tangible assets like gold and silver, you can protect your wealth from the inherent risks of the fiat currency system. Stay informed, stay proactive, and remember, in the world of finance, knowledge and preparation are your best defenses against uncertainty. If you want to stay most up-to-date on the silver and gold markets, make sure to subscribe to my daily 5-minute silver and gold newsletter. It provides the latest expert insights, breaking news, market trends, and investment strategies, all in a concise format. Click the first link in the description to join thousands of others and enhance your investment knowledge right now. If you enjoyed this video, please give it a thumbs up and subscribe to my channel. Your support helps me stay motivated to bring more valuable content to you. See you in the next video.